Hi, this is James Shrug at Westpac with the end of day report for Tuesday, July the 31st. A little bit of a negative day in Europe. There's still this burning expectation that we're going to see an awesome announcement from the European Central Bank on Thursday. Although today the German Finance Ministry said that they saw no need for a banking licence for the European Stability Mechanism, which is one of the plans that's apparently on the ECB's table, giving them a licence so that they can borrow money from the ECB and use that expanded firepower to support the sovereign bond market in those countries like Spain and Italy. So that was a bit of a dampener, but only modestly so. I mean, it's not up to the German Finance Ministry, frankly. It's up to the European Central Bank, which is independent of governments, no matter how big or small they are within Europe. There were some earnings results that were disappointing. BP, UBS, Deutsche Bank, all either missed analyst expectations or announced that they were going to lay off lots of workers, or had disappointing outlooks or what have you. So that weighed a bit on markets. A lot of economic data today. I'll pick out just some of the highlights. I mean, German unemployment rose for the fourth month in a row, just up 7,000 in July. But it's the weakest string of unemployment numbers we've had since the recession. And in fact, German retail sales fell in the latest 3 months, so that's April, May and June. They didn't even do that during the recession of 2008-2009, 3 declines in a row. So there's mounting evidence that the German economy is struggling. We had Euroland unemployment reported for June at 11.2%. It's the highest on record, and it's going to continue rising, particularly now that German unemployment is no longer falling and therefore no longer offsetting rising unemployment elsewhere. A lot of US data. We had personal spending, which was flat in June, despite a 0.5% rise in income in June. In fact, what's really striking about these data is that through the quarter, in nominal terms, there was basically no increase at all in spending. So the level of spending in June was the same as it was in March. In the quarter as a whole, the second quarter spending grew because it was growing through the first quarter. So in other words, the level of spending in April, May, June, when you add that together, was higher than in January, February, March, even though it had stopped actually growing in the second quarter. So that's further evidence that the US economy really is softening, and that people are saving more than they're spending, because income growth was pretty decent through the quarter when there was no increase in spending. We saw subdued employment costs, up 0.5% in the second quarter. The annual pace of growth there is 1.7%, which is the lowest it's been in a long time, and that's a function of the sluggish labour market. We did have consumer confidence in July from the Conference Board. It rose from 63 to 66. However, all of the rise was in expectations. The current component actually slipped a little bit, led by deteriorating expectations about the labour market. Some regional surveys from Chicago and Milwaukee. Chicago stayed in the low 50s. It had been running above 60 up until about March, but it's fallen to the low 50s, and that's where it stayed today, or 53.7, up from 52.9. Milwaukee absolutely tumbled from 60 to 47. In fact, that's the weakest it's been since the recession. We had house price figures in the US. They were up 0.9% in May, which is the fourth rise in a row for that series. It looks like what's happening is we're getting, after a string of negatives since the end of the tax credit for home buyers back in 2010. So prices have been falling since then, and they've been rising for the last 4 months. One of the reasons for that is that there are fewer distressed sales going on, which is a positive sign, for the housing market. But it remains to be seen how long that positive housing news, which we've seen in activity data like sales and starts and so on, remains to be seen how long that's going to last. that's about it, I think. That's enough on the data front. In terms of markets then, we've got just heading into the close, the London market is down 1% today. The French market down 0.9%. The German market's just slightly down. The Spanish market down 1.3% and the Italians off 0.6%. The Dow is just down 0.1% as I'm speaking, but it's been wobbling between positive and negative territory for most of the session so far. In terms of commodity markets, we're looking at oil prices off 1.2% today, $88.72 a barrel. Gold's down 0.1% at $1,622 an ounce, and copper prices are up 0.5% at 343 cents a pound. The Aussie dollar, it's been as high as 1.054 today, but it's at 1.051 at the moment, with equity market sentiment a little bit soft as I'm speaking. But as I say, the moves today have not been that dramatic compared to those we saw late last week and earlier this week, when the expectations for policy stimulus from the ECB and possibly the Fed were really at the forefront of investors' minds. We've got the FOMC decision tomorrow, not expecting really anything dramatic there. There may be some tweak to the language. We do think the Fed will embark on another round of quantitative easing, but probably not until the September meeting, which is after 2 more jobs reports and a whole other range of events, including the Jackson Hole conference, which would be perfect for Ben Bernanke to hint at it, perhaps, ahead of the September meeting. But of course we've got the ECB, and there's a lot of expectation on them for Thursday. Okay, that's it for now. We've got, what have we got? House price data coming out in Australia. Watch out for that, 3 hours time. Okay, speak to you tomorrow. Bye-bye.